This chapter covered a wide range of topics related to life insurance. Let's see how well you were paying attention. In group life insurance, who receives the master contract? The employer. Can you give some examples of qualified retirement plans? Traditional IRA, Roth IRA, Simple, SEP, and 401k. When would life insurance death benefits be tax-free? If paid as a lump sum to the beneficiary. Did you get all the answers? Before moving on, take time to reflect upon the learning objectives for this chapter. Understand the concept of third-party ownership. Know the difference between a viatical settlement and a life settlement and when each can be exercised. Understand the differences between individual and group insurance. Know the major types of coverages specifically designed for businesses. Describe the differences between qualified and non-qualified retirement plans. Understand general taxation rules for policy premiums, dividends, and death benefits. Know what Social Security benefits are available and how those benefits are determined. You've completed the general knowledge portion of your course, and now you're ready to move on to state regulations. You should be proud of yourself for getting this far. You're doing great.
No one can predict the future, but a person can be prepared and ensure that their loved ones are protected in case anything unforeseen happens. This is the basic idea behind personal life insurance. There are several common uses of personal life insurance. Let's explore them. The first and probably the most popular reason is survivor protection. The insured wants to protect the people they're leaving behind, the spouse, children, or elderly parents should the insured die prematurely. The designated beneficiaries will receive the death benefit from the policy income tax-free, which can provide funds necessary for the survivors to be able to maintain their lifestyle in the event of the insured's death. Life insurance creates an immediate estate, meaning by purchasing a life insurance policy and paying the first premium, the insured instantly establishes an estate of at least that amount. An estate means a person's assets. Life insurance may also be used for estate conservation when life insurance proceeds are used to pay inheritance taxes or federal estate taxes, so the beneficiaries do not have to sell off the assets. Cash accumulation is another reason someone may want to buy life insurance. Permanent life insurance policies build cash value, which is available to the policy owner while the policy is in force. The policy owner may take out a loan from the policy's cash value or receive the policy's surrender value if they no longer want insurance. As a result of the cash accumulation, life policies provide liquidity to the policy owner. So, these are the basic personal uses of life insurance: survivor protection, estate creation, estate conservation, cash accumulation, and liquidity. Businesses may face significant financial losses if their owner or the key employee were to die unexpectedly. So, there are several life insurance arrangements designed specifically to meet the needs of a business. And a business would buy life insurance for the same reason an individual does. It provides immediate funds upon the death of the insured. So let's look at the three most common business uses of life insurance. Imagine a small business that has one employee with very specialized knowledge and skills that nobody else in the company has. If that employee died suddenly, the business would no longer have someone to fulfill those unique skills, which could be detrimental to their operations. It will also be very expensive to find and retrain a replacement. To prepare for this type of situation, the business could purchase key person insurance. The business would purchase a life policy on their key employee. The business is the policy owner, so they will have to pay the premium. The business is also the beneficiary, so they will receive death benefit if the employee dies. This is the insurance that is put in place to protect the business, not the employee. It doesn't pay the employee's survivors. It pays the business to help them cover the expenses of hiring and training a replacement employee. Another option for continuation of a business is a buy-sell agreement. It's a legal contract created by lawyers that specifies what will be done with the business in the event that an owner or partner dies. This is also referred to as a business continuation agreement. A life policy funds that agreement and provides the cash necessary for the buyout. For example, if a business is owned by two partners and one of the partners dies, the life policy will pay a lump sum benefit to the remaining partner, and that money will be used to buy out the deceased partner's share of the business. It gives the business the money that they need to keep the business running. There are several types of buy-sell agreements that may be used, depending on the business structure and needs. For example, a cross-purchase buy-sell agreement allows multiple partners to take out policies on each other. An entity purchase buy-sell agreement allows a partnership to take a policy out on individual partners. Finally, life insurance may be used for an executive bonus agreement, which allows employers to provide special compensation to their key executives or highly compensated employees in the form of life insurance. The employee is the policy owner and has full control of the policy. However, the employer covers the cost of the policy by periodically giving the employee a bonus big enough to pay the policy premiums. Since premium payments are treated as a bonus, the premium amount is tax deductible to the employer and taxable to the employee.
When we talk about qualified plans, we refer to retirement plans that are approved by the Internal Revenue Service and offer tax advantages to their owners and beneficiaries. There are individual qualified retirement plans, and we'll discuss them separately. There are also plans set up by employers for their employees. So let's focus on the required characteristics of employer-sponsored qualified plans for now. First of all, a qualified plan must be designed for the exclusive benefit of the employees and their beneficiaries. The plan must also be formally written and communicated to the employees. The plan participants must be given the plan summary, a description of all the coverages, information on how to get their money, things like that, and it must be in writing. A qualified plan may not discriminate in favor of the prohibited group, company officers, stockholders, or highly paid employees. For example, on a profit-sharing plan, the company may decide to share its profits with everybody participating in the plan at 3% of each employee's pay rate. Granted, for a highly compensated officer, 3% is going to be a much higher amount than for a new employee. But the employer is applying the exact same percentage to every person in the plan. And that's what keeps it from being discriminatory. Qualified plans are intended to be permanent, meaning employers cannot be setting up pension plans or profit-sharing plans as a short-term strategy for their own profits. If the employer is unwilling to continue funding the plan, there is a risk that the IRS might disqualify it and revoke its tax-favored status. And finally, a qualified plan must have a vesting schedule. Vesting means ownership, So when we talk about a vesting schedule for a qualified plan, we are referring to the money that the employer has been putting into the plan on an employee's behalf, and that eventually will be fully owned by the employee. For example, employees may contribute their own earnings to a 401k plan set up by their employer, and the employer may decide to match those contributions. Employees are always 100% vested in their own money they put into the 401k plan. However, it may take a few years to be fully vested in the employer's contributions. The use of a vesting schedule that requires an employee to complete a specific number of years of employment before having a right to employer contributions encourages employees to stay with the employer. To recap, an employer-sponsored qualified retirement plan is approved by the IRS, which then gives both the employer and employees tax-favorable benefits, as long as the plan meets all of the requirements we just discussed. Let's talk about individual qualified retirement accounts, or IRAs. For your exam, you need to be familiar with the two types of IRAs, traditional and Roth, and the similarities and differences between them. Let's cover the similarities first. To qualify for either a traditional IRA or a Roth IRA, an individual must have earned income. Earned income means salary, wages, and commissions, but does not include income from investments or trust funds or unemployment benefits. So any person with earned income, regardless of age, may contribute to an IRA or a Roth IRA. Contributions to both types of accounts have the same annual limits, as established by the Internal Revenue Service. Each account owner is only allowed to contribute up to a specified maximum dollar amount per year. It could be 100% of their earned income, as long as it's not higher than the annual limit. Individuals age 50 or older are also allowed what's called a catch-up contribution, which is an extra $1,000 per year. Excess contributions beyond the annual limits will be subject to a tax penalty. For your exam, you do not need to memorize the specific dollar amounts, since those numbers change annually. You just need to understand that there are limits. And this is it for similarities between a traditional IRA and a Roth IRA. Now, how do they differ? First, let's look at contributions again. Contributions into a traditional IRA are made with pre-tax dollars, so before the taxes come out of the owner's income. They are also tax deductible for the year of the contribution. Distributions, however, are fully taxable. Remember, income must always be taxed, either on the way in or on the way out. With Roth IRAs, it's the opposite. Contributions are made with after-tax dollars, so after the owner already paid their income taxes, and are not tax deductible. That means that the distributions are received tax-free. The other difference is when the account owner is allowed or required to start taking distributions. With both traditional IRAs and Roth IRAs, taking money out before age 59 and a half is considered an early distribution and will result in a 10% penalty. There are some exceptions to this rule, such as being totally disabled or needing money for catastrophic medical expenses, making the down payment on a first home, or withdrawing money for post-secondary education. However, in a traditional IRA, there is such a thing as the required minimum distribution, or RMD, and the owner must start receiving distributions from the IRA by the specified age. Currently, it's the age of 73. And there is a penalty if the owner fails to start distributions by that age. So again, in a traditional IRA, the owner may start receiving distributions at age 59 and a half, but must start receiving them no later than age 73. Roth IRAs do not have the RMD, so the owners may continue contributing money to the account as long as they want. Make sure you understand the similarities and differences between traditional IRAs and Roth IRAs. Questions may come up on your state exam. Let's look at specific examples of most commonly used employer-sponsored retirement plans, and we'll present them in the order of small to large employers. Note that all of these retirement plans have annual contribution limits established by the IRS, but you don't need to memorize those dollar amounts for your exam. The first one is an HR10 or KEO plan. You may see them referenced by either name or both names together. An HR10 KEO plan is for self-employed individuals only. That's a key qualifier right there, self-employed. These plans allow the self-employed individuals to fund their retirement programs with pre-tax dollars, just like in a corporate retirement plan. KEO plans have the same distribution rules as individual retirement accounts. Distribution must start no earlier than age 59.5 and no later than age 73. Next are Simplified Employee Pension Plans, or SEPs, for the self-employed or small employers. These plans are easy to set up and far less expensive for an employer than profit sharing or other big pension plans. The employer sets up IRAs for their employees and makes contributions. The main difference between a SEP IRA and an individual IRA is that much larger annual contributions are allowed into a SEP. Another type of retirement plan that a small employer can set up is a simple plan. Savings Incentive Match Plan for employees. The thing you need to know about a simple plan is that it is for businesses with no more than 100 employees. To establish a simple plan, the employer must not have any other qualified plan already in place. You probably heard of 401k or profit-sharing plans. Any employer can offer them. It's a qualified retirement plan that allows employees to take a reduction in their current salaries by deferring amounts into a retirement plan. The employer can choose to match what the employee puts in, dollar for dollar, or on a percentage basis. It's up to the employer. Because employee contributions are excluded from the individual employee's gross income, in other words, they are pre-tax contributions, the employees avoid current taxes on that portion of their income. But what that also means is that when an employee takes any of that money out, it's all going to be taxable at ordinary income rates. There is also a specialized qualified plan that you need to know about. A 403B plan, or a TSA, a tax-sheltered annuity. There are 3 types of employers eligible to set up a TSA for their employees, and they are public schools, colleges and universities, churches, and nonprofit charitable entities that are tax-exempt under Section 501c3 of the Internal Revenue Code. That's the main thing you need to know about TSAs for your exam. Who is eligible for them? Let's recap all of these employer-sponsored qualified retirement plans. HR10 KEO plans are for self-employed individuals. SEPs are for self-employed or small employers. Simple plans are for employers with no more than 100 employees. 401ks are profit-sharing plans for any employer. And 403b TSAs are tax-sheltered annuities for employees of public education systems and certain nonprofit organizations. While taxes are a very complicated subject, and as an insurance producer, you are not expected to give tax advice to your clients, you should always refer them to a tax specialist. For your exam, you need to understand the basic principles of taxation that apply to life insurance. First of all, let's review some basic taxation terms. Taxable means subject to state or federal taxes. Tax deferred means taxes are paid when you withdraw funds sometime in the future, instead of paying them up front when you make contributions. Tax deductible means a certain amount or an expense can be subtracted from taxable income, which results in lower tax liability. So, which of these taxation terms apply to premiums and to death benefits in individual life insurance policies? Policy premiums are a personal expense for the policy owner. It's the price you pay for a product that provides insurance coverage, so they are never tax deductible. It's as simple as that. Now, what about the death benefit? The main reason people buy life insurance is to protect their loved ones if the insured dies unexpectedly. If the beneficiary receives the death benefit in one lump sum, that payment is 100% federal income tax free. Lump sum is the key word here. If, however, the policy owner or the beneficiary chooses to receive payments in installments, which means some of the money will remain with the insurer and will continue to earn interest, the interest will always be taxable. The principal, or the money that the policy owner paid into the policy in the form of premiums, will not be taxed. Even though the purpose of life insurance is to protect survivors from losses suffered after an insured's death by paying out the death benefit, some life insurance policies allow the policy owner to receive living benefits. Let's talk about the benefits that the policy owner may have access to. First of all, remember that only permanent insurance allows for living benefits because it has cash value. So a whole life policy, or a variable life policy, for example, but not term life. The cash value in the policy grows tax deferred. But if the policy owner decides to surrender the policy, any cash value in excess of the premium paid will be taxed as ordinary income. The policy owner may also borrow money from the cash value and take out a loan from their life policy. Policy loans are not taxable as income, but the insurance company will charge interest on any outstanding policy loans. The policy owner does not have to repay the loan while living, but any outstanding loan and interest will be subtracted from the death benefit when that's being paid to the beneficiary. If there are dividends on participating policies from the mutual insurance companies, they are considered a refund of overpayment of premium. So the policy owner will not have to pay any taxes on the dividends. However, if they decide to leave the benefit with the insurer to accumulate interest, any interest earned on the dividend will be taxed as ordinary income each year. So again, dividends are not taxed, but interest is always taxed. One more living benefit that is available in permanent life insurance is the accelerated benefit. If the insured becomes terminally ill, they may use some of the policy's face amount to pay for necessary care. Accelerated benefits are received tax-free up to a certain limit, and any amount received in excess of this dollar limit will be included in the insured's gross income and will be taxed. Remember that deferred annuities offer tax-deferred accumulation, meaning taxes are paid when the owner withdraws funds sometime in the future, instead of paying them up front when the contributions are made. That's why people like to invest in them. The annuity grows, but you're not paying tax on the growth as long as that growth stays in the contract. Now, if the contract owner were to take a withdrawal during the accumulation period, that money will be taxed on a last-in, first-out basis, or LIFO. That means the interest is paid out and taxed first, and then, once the interest is depleted, the principal amount will be received without taxation. As a producer advising your clients, you may want to discourage them from taking the money out during the accumulation period, because not only will they most likely be required to pay a 10% penalty for an early withdrawal, but they will also have to pay taxes on any annuity growth first. That's not what the annuities are designed for, so you'd want to protect your clients' assets and make sure they understand the tax consequences of early withdrawals. Now, what if the annuity owner decided to surrender the annuity during the annuitization period and receive lump sum cash benefits? A cash surrender results in immediate taxation of the interest earned, and it will be taxed at the owner's ordinary income rate. What if the annuity owner dies before the annuitization date? As with any insurance products, interest accumulated in the annuity is always taxable. If the owner dies during the annuitization period, any unpaid annuity benefits will be paid to the beneficiary and are taxable. The Internal Revenue Service, IRS, imposes a penalty for certain premature distributions from annuity contracts. In addition to ordinary income tax that may be due, a 10% penalty is imposed on the annuity for early withdrawals prior to age 59 and a half. This is sometimes called the 59 and a half rule. The main purpose of an annuity is to save money for retirement, so this rule discourages people from dipping into their retirement savings too early. There are exceptions to the 59 and a half rule, so the annuity owner could take the money out prior to age 59 and a half without paying the 10% penalty. For example, if the owner becomes totally disabled and has no income or incurs catastrophic medical expenses, the 10% penalty will be waived, even if the annuity owner is under the age of 59 and a half. Another allowable reason is purchasing a first home, so the annuity owner will be able to make a down payment. The key here is it has to be a first-time home purchase, and the withdrawal is limited to $10,000. Money from an annuity can also be withdrawn without the penalty if it is needed for post-secondary education expenses, such as going back to college. Those are the exceptions to the 59 and a half rule. However, the annuity owner will still be paying any applicable taxes on the withdrawals, just not the penalty if it's one of the exceptions. Let's talk about an area of life insurance taxation that is often confusing for learners: values included in the insured's estate. Hopefully, this will add some clarity for you. The face amount or the death benefit from a life insurance policy may be included in the insured's taxable estate when the insured dies, and is subject to the federal estate tax in the situations when there are incidents of ownership. What does that mean? If at the time of death, a person had a life insurance policy that they owned in their name, that is considered an asset of the insured's estate. The amount of life insurance has to be included in the list of all of the assets that are owned by the insured at the time of death in order to figure out how big their estate is, and if there are going to be any special estate taxes or inheritance taxes that are due. That's all it means. The beneficiary will still get the death benefit paid to them tax-free. The term incidence of ownership refers to whether the insured's estate is going to have to pay any taxes. If the insured's estate is the designated beneficiary at the time of the insured's death, the entire face amount of the policy will be included in the insured's taxable estate. Then there is also the transfer of ownership. If an insured, as the policy owner, assigns or transfers the ownership of the policy to somebody else, or makes a gift of a life insurance policy within 3 years prior to the insured's death, the entire face amount of the policy is going to be included in the insured's taxable estate. Because what it looks like to the IRS, the Internal Revenue Service, is that the insured may have known they would die soon and tried to get assets out of the insured's name to lower down the estate taxes. So the policy will still be listed as an asset on the insured's estate if it was assigned or gifted within 3 years of death. So to recap, when we talk about values included in the insured's estate, we are referring to incidence of ownership, transfer of ownership, or estate being the beneficiary of the policy. There may be some estate tax implications. Modified endowment contracts, or MECs. Let's talk about them. A modified endowment contract is basically an overfunded life insurance policy that may have been purchased for the purpose of setting aside large sums of money and avoiding paying taxes. To discourage those activities, the IRS established what is known as the 7-pay test, and all life insurance policies are subject to a 7-pay test. In addition, a new 7-pay test is required if there is a material change in the policy, an increase in the death benefit, for example. Let's see how that works. Let's assume somebody wants to purchase a pay-to-age 100 whole life policy with $100,000 face amount that requires $100 monthly premium. Now let's apply the 7-pay test. Let's say that it is calculated that a $100,000 7-pay whole life policy requires a $500 a month premium for 7 years, and then the policy is paid for. A total of $42,000 in premium. So if the policy owner paid excess premiums and exceeds the $42,000 in the first 7 years, the policy becomes a modified endowment contract and loses its tax advantages. So the cumulative premiums paid during the first 7 years of the policy exceeded the total amount of net level premiums that would be required to pay up the policy. The policy owner paid more into the policy than they were allowed to pay during the first 7 years. Once a life insurance policy fails the 7-pay test and becomes a MEC, it remains a MEC. The policy owner cannot just take out the extra money and regain some of the tax benefits of a life insurance policy. It's very important for you to remember that once a life policy becomes a MEC, it's always a MEC. A modified endowment contract still offers tax-deferred accumulation, but any distributions from it, including withdrawals and policy loans, are taxable, as opposed to tax-free on a life insurance policy.